We already mentioned that we can think of climate solutions, mitigation actions in terms of market-based approach or regulation-based approach. So this cluster of market versus regulations clusters, the book is unabashed about its favoring the market-based cluster. Well, University of California system, California is probably considered like the fifth largest economy in the world, for example. It's the home to Silicon Valley with the four giants, Facebook, Google, Amazon, and Apple, even though Amazon is centered in Washington. So obviously, market-based solutions kind of are coming out of there a lot of times. Okay, there are pros and cons of the two. Under the market-based solution, for example, you have dealing with carbon as cap and trade and taxing carbon. So by the way, already cap and trade has been tried, and you will find reports saying it's not very effective. Taxing is never popular because the word tax itself begins to rile up people's and corporates' passions. So, nonetheless, briefly, how do they work? This is from this Green Economy website. You have a high emitter and a low emitter. So there is a cap that is set for both. The low emitter is under the cap and the high emitter is above the cap. So the high emitter can trade their emission excess to the low emitter and buy the permits from them. So there is a tradable offset because the allowable emission of the low emitter is below the cap. So this is kind of a system that has worked, but apparently it has led to just trading emissions rather than reducing total emissions, right? So instead of this one being pushed down here and this one staying here, now you have transferred some emission from there to there. So the tradable offset is not always a way to reduce. Whereas if you tax the emissions, then the higher emitter would pay more tax, whereas the lower emitter would pay less tax. Okay, in either case, obviously the cost gets sometimes transferred to the consumer, so that also has to be considered. And there are many studies that show that people respond to these options based on how it is pitched. If you pitch that you will tax carbon and use the money to clean up the environment, you get more support than if you just say you're going to tax the carbon. People feel better if you say that money is going to be used for cleaning the environment. Okay, so those things matter in terms of behavioral aspects or perceptions of risk and government control of resources. Okay, solution number 5 under that, adopt market-based instruments to create efficient incentives for businesses and individuals to reduce CO2 emissions. Okay, that's important. How do you give incentives? That's the whole can of worm as well, because this is a report from the Vox based on some papers, reports from the UN and so on, which talks about fossil fuels being underpriced by a whopping $5.2 trillion because they are subsidized. Every government is subsidizing coal, oil, and natural gas. Okay, we can't take on climate change without properly pricing coal, oil, and natural gas. But this is a huge political challenge. So if you're a car owner and you're driving, then as soon as the gas price goes up, you're going to complain. And Al Gore, I think, had said that taxing gasoline is politically inaccessible. You cannot raise taxes. People are very sensitive about it. Prices do go up and down based on the production, and countries like India and China and continents like Europe do tax gasoline more than the US, but still they are subsidized. So here is the investment in shown for fossil fuels in billions of US dollars, anchored to 2017. So the faster transformation scenario investments needed to head here, okay, this is close to 5 billion here by 2025, avoiding spending 10-year delay. So you want to reduce the subsidies. Spending includes capital and operational expenditures, and you want to phase it out quickly. So if you avoid spending with a 10-year delay, then you add some cost by 2025, and you can see 2030. So this is additional spending with 10-year delay. So transitioning to a low subsidy, low carbon economies requires spending money on transformations of the infrastructure, for example. Then the question is whether you recover the cost quickly enough. And the IEA report, International Energy Agency report, basically argues that the investments you make in the transitions will be more than recovered after the transition is complete in terms of CO2 emissions reduced and all the other operational and capital costs needed for the transformation. Okay, hard sell basically because people are comfortable with what they are enjoying already. So this is a challenge we can't afford to ignore, according to the World Bank. The labor income losses are on the rise because of air pollution related to fossil fuel burning. So the cost of labor losses was 162 billion in 1990. By 2000 it was 163. By 2013 it was $225 billion. Okay, this is just lives lost and higher costs each year. Air pollution is a challenge that countries cannot afford. So briefly, here is the environmental policy instruments towards market-based solutions and non-market-based solutions. Market-based instruments include taxes, emission trading, removal of perverse incentives, liability rules, deposit fund, and so on. Non-market based instruments go towards command and control regulations, reporting requirements, active green energy technology transformation support, incentives for example, removal of green tech financial barriers, this is important, information and voluntary approaches. So many corporations in the US, for example, the Big Four, are announcing that they will go to carbon neutrality by a certain year, they will go to 100% renewable energy by a certain year, and so on. Basically, their own vulnerability to power energy requirements is increasing because of cloud computing and data storage facilities. They have enormous cooling requirements and power requirements when it comes to storing all the data. Everybody is capturing data. Every time you get on the web, every time you use a software, every time you use an app, they collect data, and the data is used for improving the marketability, products, profits, and so on. Of course, ease of the product use for us as well, but all that data gets stored somewhere, and that requires massive amounts of energy. So they have incentives to try to do something about this power requirement, because that power requirement itself begins to chew into the profits, right? So if you can get renewable energy from cold coastal waters of California, or winds in South Dakota, or geothermal heating, cooling somewhere else, then obviously they will and they should go for it. Okay,